Ready, Jim? Okay, I'm ready. Good. Good afternoon, everybody. My name is Allison Chow. Welcome to the Hire Smart event sponsored by LinkedIn and Intuit. We're here for a session about full-time employees versus independent contractors. I'm with the firm of Carruthers, Asante, and Frudenberger. We are a statewide labor and employment law firm with 5 offices throughout the state of California, representing exclusively management, so employers like small business owners like yourself. And the reason this topic was chosen is because there is a lot of confusion and uncertainty about when and whether you can hire an independent contractor versus an employee. And so I'm going to start with the first slide, going directly to a news clip ran by CBS about a year and a half ago, just to give you an idea about how big of a problem this is and how forcefully the state and local governments are cracking down on this issue.
So when is an employee not an employee? The Labor Department is cracking down on businesses that
So as you can see from that news clip, this has been a focus of the state, local, and federal governments in the last several years, primarily because of the recession. And due to the downturn in the economy, many business owners are turning to alternative and contingent workforces instead of hiring direct employees, thinking that that's okay. And a lot of times, the business owners don't really understand the differences between what is an independent contractor versus what is an employee. And they have some general misconceptions as to when they can hire an independent contractor. So hopefully, through our short presentation today, I can give you some of those common misconceptions and mistakes and help you avoid potential liability. In 2005, and this is the last time this kind of data was available, the federal government estimated there are about 10.3 million workers who are classified as independent contractors, and approximately one-third of those are misclassified. So you can understand the reason why the government at all levels is cracking down on this misclassification, because it is the loss of revenues, tax revenues for the government, and increased burdens on the government in terms of paying for workers' injuries, unemployment benefits, et cetera, that are not paid by the business owners. So as a result, there is a high enforcement effort by the government at all levels to crack down on this misclassification issue. There are increased audits. The California Labor Commissioner has formed a criminal enforcement unit to actually arrest business owners for violations of the labor code. So this is actually really serious. You're not just looking at monetary and civil penalties, but potentially criminal enforcement. Now, some of the more common areas where misclassification arises in the construction industry, the trucking industry, as we've just seen, real estate, home care providers, people who send nurses and home aides to clients' homes, janitorial services, and actually high-tech jobs. So those are the target areas of audits for the state and local governments. I'm not saying that doesn't happen in all industries. It does, but they have focused their enforcement efforts and audits on those particular industries. And the reason is because the federal government and state governments lose billions of dollars of tax revenues when people don't classify their employees correctly. And independent contractors often are found to underreport their income as well. So that's why you have this endemic problem. And the Obama administration has actually hired 100 new enforcement agents to really focus on this problem. Now, what are your potential exposure as a business owner when you misclassify a worker as an independent contractor? Now, obviously, we talked about federal, state tax liabilities and penalties, but there are a whole host of other issues that you could be liable for in the event of misclassification. One, obviously, for the unpaid minimum wages, overtime, and regular wages. A lot of people believe that when you have an independent contractor relationship, you should pay by the job. And in a proper classification, that is true. But when you are found to have misclassified somebody, they're going to say, I worked 40 hours or 50 hours a week, and 10 of those hours are overtime hours, so it's time and a half, what the wages would otherwise be if you paid them by the hour. And so you can see how that quickly adds up. You could be liable for meal and rest break violations, tort liabilities for injuries. If you had an independent contractor that was injured on the job and they were found to be an employee and not a contractor, you would have to pay for their workplace injuries. And tax liabilities include workers' compensation insurance benefits, unemployment insurance benefits, and things of that nature. And obviously, the attorney's fees and costs if you are found to be liable and that is sued upon in a court of law. Now, why is it such a difficult area for employers to comply with? And it's because there is actually no legal definition as to what is an independent contractor. So here you're thinking, great, this is a really big area of enforcement. I could be facing all of this potential liability, and there's no legal definition, so how am I supposed to comply? And we're going to talk about a number of various factors that the different state and federal agencies look at when they're looking at auditing you and your workforce. But a lot of it comes from court interpretations when there is a lawsuit and it's filed, and there's some determination as to whether or not you misclassified somebody. And then the various agencies have developed their own guidelines and various factors in terms of how they look at employees versus independent contractors. But you need to remember that the law under California presumes that all workers are employees. So you're already starting off sort of at a disadvantage because the law presumes them to be an employee unless you have sufficient indicators and circumstances showing that they're really an independent contractor. And the leading California case, for all those who want to Google this after you go home, is Burrell and Sons versus Department of Industrial Relations. It's a 1989 case, and there's been many subsequent cases about independent contractor relationships, and I've listed a couple of those. Now, a common misconception that people have is that if I have an agreement with a worker, and I call this worker an independent contractor, and this person agrees with me that he's an independent contractor, we have an independent contractor relationship. And these cases say that that is not true. It doesn't matter the labels you use in the relationship. It doesn't matter that you issue a 1099 as opposed to a W-2. And none of that, sort of the legalistic things that you would look at in thinking that that is determinative of the relationship really is not determinative under the law. And what the law really looks at is what's called the economic realities test. I'm going to go through some of those factors in a little bit. But generally and most broadly speaking, they're talking about what is the manner and mode at which the services are provided for you. And it's a kind of amorphous concept, but generally how much and how in-depth are you controlling the relationship in terms of how the services are provided for you. If you are controlling it to a degree that this person looks like an employee and is performing all of the duties that your regular employees perform for you, the law is going to say that this person really is your employee and not an independent contractor. So here's the first test, and this is the California DLS See Test, and it lists some of the factors that the agency looks at. Now, you need to remember that none of these factors in and of themselves are determinative, and a court or a jury looking at these factors can weigh the factors differently, which is why the tests are a little bit difficult to understand and grasp. But one of the most common ones is this person in business for himself or herself? So if the person is hired for a special project, let's say you want to have someone design a website for your company, and this person has a website design company and comes in and does that for you, that's one of the significant factors in showing that this person actually is an independent contractor. They have their own business. They sell their services to other people besides you. That's a really important factor. Whether the person supplies their own instrumentalities or tools. So, do they come with their own expertise and knowledge? Do they have their own computers, equipment, whatever it is that they use to perform their services for you? Or are you providing all of those equipment? Are you providing their office? Are you providing the secretarial support? Are you providing the computers, the phones, et cetera, all of the administrative support that you would expect an employer to provide for their employees? So the more of the provision of equipment and tools that you provide, the more it's going to look as if this person is your employee. Now, whether the person has an opportunity for profit or loss, which is number 7, and that's very closely related to whether this person's in business for himself or herself. So, for instance, if the contract that you have with the independent contractor says, if you finish, X project, a week ahead of time or 2 weeks ahead of time or a month ahead of time, you get this extra bonus. Or if, the success of the work that you provide, renders, a result that's beyond what the parties contemplated, you get an X bonus. Something along those lines would be very good in terms of substantiating your position that this person is an independent contractor. Now, 8 and 9 are close related and also important factors that courts and agencies look at. It's the length of time that the services are to be performed for you. Many companies have independent contractors work for them for years, year in, year out, and they're an independent contractor. And the law says that the degree of permanence in the working relationship is indicative of an employment relationship. So generally, the idea is if you hire an independent contractor, it's for a temporary, short-term, or project basis, and that project is going to be completed at some point in time. And if you don't see that, that is sort of a red flag for government agencies. Now, the IRS has a similar test with many of the similar factors, but they group it into 3 conceptual groupings. One is the behavioral control, so sort of the idea of how much is the principal or the business owner controlling the work that's being performed. Are you dictating the sequence of how the job's performed, who is performing them, Or are you giving the independent contractor a significant amount of discretion and leeway in performing that job? Can they hire their own employees? Can they delegate the task? Can someone else do that work so long as the project is completed, by the deadline that you agree to? So the more control you exert over the relationship and how the work is performed, the more it's going to appear as if the person is an employee. Financial control. Are you reimbursing business expenses? A lot of times, independent contractors will ask to be reimbursed for cell phone usage, mileage, etc. And under a pristine independent contractor relationship, none of that is reimbursable. And employees do expect to get reimbursed for all of those business-related expenses. So that is a significant factor. And how are you paying this independent contractor? Are you paying them by the job? Are you paying them hourly or weekly or monthly? The more it looks as if you're paying them on your regular payroll, as if you would pay your employees, the more it's going to appear to a court or jury that this person really is an employee. And again, the type of relationship, although it's not determinative and not dispositive, written contracts are taken into consideration. So, you should have contracts with your independent contractors that really lay out the relationship. Do I have a question?
In terms of the financial control, did you say that employees will be reimbursed or not reimbursed with the
employees will be reimbursed. Independent contractors are not. They are supposed to bear their own expenses for the job.
We also had one question online, which was, what about interns, and how do they fit in this contractor versus employee?
That is a completely different. It's a completely different inquiry, and it's not something that it's covered by our presentation here. But interns generally have different legal tests in terms of when you can actually have an intern, when you can pay them as an intern or not pay them as an intern, and that's completely different. This is when you are actually paying people like you would an employee, but it's on a separate legal basis where you wouldn't pay the payroll taxes and cover a lot of the benefits that you would for your employees. Okay. So I'm going to skip over the EDD test, which covers a lot of the similar factors that we just discussed. But the EDD looks at these three primary factors in considering whether you have an employee or an independent contractor. Can they quit or be terminated at any point in time? If they can, that is an employee, as opposed to a contractor who's supposed to complete a job or a project for you. Do you have a manager reviewing their work, giving them performance reviews and giving them direction? If you do, that is a factor that's going to appear as if the person is your employee. And most importantly, is the worker performing a job or a service for you that is a regular part of your core business? If it is, there is a very significant determination that is a strong factor indicating this is an employee. Okay, so here's a summary again for you in your PowerPoint presentation that you'll have access to. I have handouts here, and I think that it's also available online for those who are interested. That covers a lot of the factors that we just discussed. Here are a few cases that have come up in the independent contractor analysis recently, and I'm not going to have time to talk about a lot of them, but suffice to say the first two cases, Estrada and Chrysler, are both truck driving cases, and they came to opposite conclusions. So the fact is, you can have different factors that can affect the analysis. In Estrada, the workers were provided with uniforms. They were given specific routes. They were given equipment by the company. They leased the trucks that they drove, and the deductions were taken out of their regular weekly payroll. So all of those factors, led the jury and the court there to conclude that those were actually employees and not independent contractors. In Chrysler, the opposite conclusion came, where the truck drivers actually had their they had entered in an agreement with the company where they were able to bid on routes. They were able to negotiate management fees. They were able to hire their own employees. And as a result, the jury concluded in that case that those were actually independent contractors. So you can have the same industry, you can have the same position, and come to different conclusions. And it depends on the various factors we just discussed. Okay. So what is the wave of the future in terms of how employers and business owners are dealing with this issue. One is to reclassify if they have consulted with counsel and they believe that the workforce that they're using really should be employees and not independent contractors, they do reclassify. And the IRS has provided certain incentives and safe harbor rules to allow employers to do that and minimize the penalties for back taxes for doing that. But if you are going to do it, you should definitely consult with counsel so that you're not at risk for a huge audit. And many employers are also using temporary staffing agencies to deal with this issue, hoping that they can pass off that risk to the staffing agencies. So you can see the inverse use of independent contractors and increased use of staffing agencies to deal with this issue and problem. But the point to remember is you can't rely on staffing agencies to do the right thing. You really need to look at that relationship to see how the staffing agency is treating those employees. Because a lot of times the staffing agencies are calling those people independent contractors too and not doing the right thing and not paying the taxes, et cetera. And you can be liable as a joint employer under those circumstances. So it's very important not to think that you're out of the woods just because you're using a staffing agency. So here are the key advice points for you to take away with you. One is the label is not sufficient, as we've all just discussed. Don't rely on another company's classification, as we just discussed. Apply your anti-harassment and discrimination policies equally. Now, one of the things that we talked about is not treating your independent contractors like your employees. Don't provide them with the same benefits and vacation policies and 401k plans and things of that nature. But the exception to that rule is your harassment and discrimination policies, because that carries with it huge legal ramifications and exposure. So it's in that instance, we caution our clients that it's better to be safe and to universally apply your harassment and discrimination policies to everybody. Be very careful about prolonged use of independent contractors as part of your regular workforce. Don't subject your contractors to employee protocols like employee benefits, regular payroll, expense reimbursement, things of that nature. And if they are an integral part of your business, think twice about whether that person should be an employee or not. Maintain clear records for your attorney in case you're ever audited. Have those independent contractor agreements, spell out the various ways in which they qualify as an independent contractor based on the factors we just talked about today. And if you have to reclassify, do it very carefully and consult with an attorney to do it so that you're not drawing attention to yourself. Okay. So thank you very much for attending the presentation today. I'll open it up for some questioning.
Hi.
Hi.
So in the case where we want to pay people referral fees, and some of these referrals may be doing indirect work for our clients as well. How do we pay them? Do we pay them as contractors? And especially if they're on retainer in our firm and they're just getting referral fees every year, how are these people classified, and what is it recorded on our books?
So the question is, if a business owner is using sort of a recruiting company, and that company is providing you with staffing on a regular basis, is that the question?
Basically, I'm just giving referral fees to people that are sending me business.
Oh, okay. So is the payment of referral fees over a course of time problematic in this analysis? I don't think so. The referral fee is to provide sort of an incentive or a bonus, for referring work or business to you. That's not usually a problem. That's not something that the courts really look at.
And if those same people that I'm paying referral fees to are doing business from time to time for my clients, would they be considered contractors at that point?
I don't believe so. I don't believe so. If they have their own separate company and they provide services to you and to others, I think that's actually a good factor.
Okay, I think we're going to do one more question and then wrap it up.
Okay.
Okay, so there's a lot of negative aspects to bringing on a independent contractor. Could you give some examples of when it would be a good time or how it would be effective?
if you have a specialized project and your company doesn't have that unique skill or tool set, for instance, the web design illustration I just provided, that's a great opportunity for you to use independent contractors, and it is a legitimate use of independent contractors. And you're not, when you satisfy all of those conditions that you've correctly hired an independent contractor, you're actually saving about 30% of your payrolling expenses by not hiring the person as a direct employee. You don't have to pay, the employer's portions of taxes, workers' compensation, liability insurance, unemployment insurance benefits, the benefits that you normally provide to your employees, such as, health benefits, dental benefits, and things of that nature. So when it's used correctly, it's a big payroll deduction. Okay, great. Well, thank you very much for attending the presentation. Enjoy the rest of your day.